Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of January 6th. Thank you for joining us. And if you find these videos helpful, don't forget to like and subscribe below and check out some of our other great content. As always, my purpose for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. Although last week was a relatively quiet week for economic reports, there were two areas that I'm going to take a minute to focus on, the first being manufacturing and the second being housing. U.S. manufacturing has been struggling for most of 2024, and unfortunately, the reports we saw at the end of December coming in last week just further confirmed those struggles. We did see a slight conflict with the S&P Global Manufacturing Report showing a slight decrease in conditions, and the ISM Manufacturing Report showing a slight increase in conditions. On average, the manufacturing sector continues to struggle as far as production, new orders, and concerns about input prices and the potential for higher selling prices, which of course contributes to inflation. Survey respondents to the S&P Global Survey mentioned that there continues to be some optimism for the future, but that there are ongoing concerns about tariffs, about inflation, and about interest rates and borrowing costs looking into next year. Switching over to housing, we saw the Case-Shiller Home Price Index come in last week, demonstrating a 3.6% increase in housing costs in the last 12 months. The 20-city composite, which focuses on the 20 largest cities or urban areas in the United States, actually showed an increase in prices, but at a slower rate than the previous month. So previously, prices had risen by 4.6%, and in October, the prices only rose by 4.2%. This is an important trend, as housing costs and housing inflation have played a large part in the amount of total and overall inflation and cost of living that we've seen in the last 3 years. The largest increases as far as housing costs were seen in New York City, Chicago, and Las Vegas, while the smallest increases were actually recorded in Tampa, Florida. In addition to these housing costs and these housing price changes, most people using mortgages to purchase their homes, we also have to mention the fact that mortgage rates have increased over the last few weeks to nearly 7% again. Mortgage rates tend to be highly correlated or closely match changes in the 10-year Treasury. So as we've seen the 10-year Treasury yields increase, we've seen mortgage rates increase in succession. Switching over to the weekly unemployment insurance program, we saw initial claims again fall down to a level of 211,000 per week. And we saw continuing claims also surprisingly fall down to about 1.8 million. And in fact, the phrase that's being thrown around in regards to the current labor market is low hire, low fire. The idea being that layoffs are relatively low and infrequent, but hiring also seems to be low and infrequent. So individuals aren't losing their jobs at a high rate, but individuals who are currently unemployed continue to struggle to find new employment. It's also important to note when we're talking about the labor market and we're talking about the October, November, December, or fourth quarter time period, there tends to be a lot of irregular hiring and layoffs related to the holiday shopping seasons. So although the data is important and the data is helpful for understanding the current trends, we will definitely be looking forward to the first 3 months of 2025 and the Q1 results, as they may provide a clearer picture of the true condition of the labor market, excluding the impact of holidays and temporary shopping seasons. Switching over to the stock market, unfortunately, the market continued to struggle again last week, with all 3 major indices losing at least 0.5 percentage point. But those losses would have been much greater had it not been for the slight recovery on Friday, which allowed the market to avoid losses greater than 1 or 2%, especially in the NASDAQ. Switching over to the fixed income side, the yield on the 10-year Treasury last week hovered between 4.5 and 4.6%. It wasn't an incredibly volatile week, especially in relation to the second half of December, but all eyes continue to focus on this 10-year Treasury rate, in part because the new inflation and new unemployment data coming in may have a significant impact on this trend. Also in part because right now the yield on the 10-year Treasury remains near record highs and continues to threaten the potential bull market that is expected for 2025. Wrapping things up from last week, we saw Bitcoin erase some of its losses and begin to return back towards the $100,000 mark. We saw gold, crude oil, and the value of the US dollar increasing throughout the week. Of special significance is the value of the US dollar, as it continues to approach the high in the last 5 years, and as the high value of the US dollar continues to threaten some of the more global or internationally oriented policies of the incoming Trump administration. Kicking off our updates for this week we'll be focused on jobs. Early in the week, we'll see the JOLTS, the job opening and labor turnover survey, so we'll be able to see what job openings, hiring, and layoffs are looking like. Towards the middle of the week, we'll see the ADP report on private sector employment. And at the end of the week, we'll see the Bureau of Labor Statistics national report on unemployment and job creation. Of course, attention will be focused on the unemployment rate as well as the wage growth. But the big question leading into this report for the month of December is whether we will continue to see the job growth, the strong job growth that we saw in September and November, or whether we'll continue to see some slowing more akin to what we saw this summer. Also coming up later this week, we'll get some insights into the activity and the confidence level of consumers as we see a consumer confidence report and we see a report on consumer credit and spending. Last of all for this week, we'll see the Federal Open Market Committee, or FOMC, meeting minutes from their December meeting released to the public. These minutes will be of particular importance because the result of the vote in December was not unanimous. There was, in fact, some dissension. And the chairperson in his press conference mentioned that it was not necessarily an obvious decision to cut. So the discussions that took place in the meeting and some of the motivations will be of particular interest to economists and analysts as we try to anticipate or forecast what interest rates and interest rate cuts will look like in 2025. Looking further into the future, of course, January means the inauguration of the new Trump administration, as well as the beginning of the first 100 days, where we expect to see a flurry of activity within the administration as far as economic policy, fiscal policy, and just general comments towards trade and consumption. The budget arguments towards the end of December have also given us some indication that we will most likely see ongoing conflict in Congress surrounding the debt ceiling. The debt will, or at least is estimated, to reach the current debt ceiling around the middle of June. So discussions from the middle of January to the middle of June could be both contentious and significantly impact financial markets as well as the economy in general. Last of all, we'll be watching fourth quarter earnings reports as well as 2024 earnings reports as they begin to roll in this week. and further into the month of January. As always, we'll continue to watch those earnings reports as well as all the incoming economic data and bring you the information that you need to stay up to speed on the markets. Thank you again for joining us. Don't forget, if you found this video helpful, make sure you like and subscribe. Check out some of the other great content we have on our page. And don't forget to come back and join us again next week. Thank you, and have a great week.